Thank you very much for joining me in this video. If you recall, last week we talked about what type of property to put in your portfolio. Remember, the Money Machine seminar espouses the idea of acquiring a minimum of 10 properties, and a number of you that follow along are going to acquire 15, 18, 20 properties. If you're already on course, you always have the challenge of the question, what should I buy next? If you're just starting out, what should I buy first? But you need a long-range view of what your portfolio is going to look like as it goes on and on. And I'm a big fan of mixing it up. Don't have all one type. Have one of this and two of that and three of that. And you want a mixture of types of property. It leaves you less vulnerable. It helps you with balance, cash flow, and so on. And last week we looked at single-family homes, we looked at semi-detached, and we looked at multifamily like duplex and triplex. Moving on this week, I want to take a look at condominiums and I want to take a look at commercial industrial. Starting with condominiums. Condominium is a structure of legislature that created a building that's partly individually owned and partly common owned. And the common owned, things like the grounds are not your concern. Things like the parking lot are not your concern. And so you don't have to worry about who's cutting the grass, you don't have to worry about who's shoveling the snow, you don't have to worry about changing the screens, you don't have to worry about exterior maintenance or whether the roof needs replacing. All these things are handled by the condominium corporation. Remember, I'm really anxious for you to be in this for the long haul. I want you to be in it 20, 30, 40 years. And the more hassle and problem, the less likely you are to stay with it. And so when you own condominiums, you don't get a lot of those calls because they're being looked after for you. The downside is you're paying for it in the common element fee every month. And that comes right off your bottom line. And in some cases, that's $500, $600, $700. It makes a huge difference in terms of whether the property will carry or not. And in most cases, it will not. It's the toughest of the properties to have it cash flow properly. So you'd say, well, who buys condos then? The person who generally, other than end user, buys condos is the speculator. I remember having a friend in Sarasota, Florida, before the meltdown in 2008, who told me that 1 year property values went up 80%, 1 year. So what you had was you had people that would buy a condo, rent it out, and they didn't care, subsidize it $600, $700 a month. Maybe they're going to invest $10,000 over the course of the year, but at the end of the year, they're going to sell it and make $100,000. So they didn't mind investing some for a substantial payout. And that's why condos can be as vulnerable as they are. When the market's really heated up, you got builders desperate to try and build condos because there's so much demand. When the market cools off, all of a sudden these speculators aren't making the money, they want to bail out, and the condos come on the market, and so they're much more vulnerable. But for your point of view, it's really nice to have some in your portfolio. And if it has to be subsidized, as long as other properties in your portfolio are creating a surplus and the whole portfolio carries, then you're comfortable. So you've got some properties that are higher maintenance, like a triplex, and other properties that are really easy to maintain, like a condo, and the whole thing cash flows and works. Another advantage for owning a condo is that you, as you get older, may decide that you want to become a snowbird and you want to spend your winters in Florida, and you think, you know what, I wouldn't mind living in a condo. Hey, you own one. You decide you're going to move in. Let's take a look now at commercial industrial. And when I say commercial industrial, I'm throwing almost everything that's non-residential under that banner. It can be retail, it can be industrial, it can be office, it can be a strip mall, it can be a custom design freestanding building that's rented out to commercial or to a restaurant or something. All these come under commercial. And there's some significant advantages to owning commercial. One is that most leases are what we call triple net. What we mean by triple net is all the additional costs and expenses of repair and maintenance fall on the shoulders of the tenant. They're not the landlord's responsibility. So the rent he receives, the gross rent, is net rent because all those expenses are passed on to the tenant. And you don't get the after-hour calls. My tap's dripping, or this, or bug has gone wrong in the unit. The tenant understands that's his problem. Another advantage is that while a lease can be any length, there's no dictation. Often in commercial and industrial, it's long-term, 5-year, 10-year, not uncommon at all. And one of the problems when you are a landlord is tenant turnover. Nobody likes tenant turnover, but you have much less of it when you have commercial industrial property. Huge advantage is that it's not under the Residential Tenancies Act. It's under the Commercial Tenancies Act. The Residential Tenancies Act is a terrible piece of legislation if you're a landlord. It's terribly one-sided consumer protection legislation, whereas the commercial legislation is much more balanced, and so that's a real advantage. Some cautions though. It's riskier. People are always going to need a roof over their head. They're not necessarily always going to need someplace to house their business. If you get a downturn in the economy and businesses shut down, you may find that there's some rising vacancies in commercial that you won't see in residential. And it's vulnerable to changes within that marketplace. For example, after COVID, a lot of people got used to working from home. A lot of companies, industries got used to having their employees working at home. And so the demand for office has dropped. Office vacancies have risen. And if you've got all your investment in office space, you may have a problem. And so that's one of the things that you have to consider. There's also the danger of what we call site-specific. Tim Hortons, as an example, great tenants. But if you've got a Tim Hortons and it doesn't have provision for a drive-through, that tenant's not going to renew when the lease comes due. They're going to look for an alternate location. And a standalone building like a Tim Hortons may not be the easiest to rent. So you got to be careful. I had a friend who owned a lot of OPP stations. Great covenant, great long-term leases, but if the police force decided to merge or relocate, go to another spot, you've often got a building that's not centrally located, and you're going to have a hard time finding a tenant. Another thing is that as a landlord, it can be costlier. It isn't triple net, and so the ongoing expenses are minimal. You're going to be responsible perhaps for the HVAC and for the paving of the parking lot, some major capital expenditures. But when the tenants turn over, a new tenant comes in, they're going to expect you to shoulder some of the costs of the lease-ups. They're at least going to want you to put the T-bar ceiling in and probably the carpeting on the floor. So you got some expenses there. And also, it's harder to buy. It's fairly easy for you and I as entry-level investors to buy a single family, a semi, or for example, a duplex. But buying a strip plaza, the bank expects a certain level of expertise. They expect you to have deeper pockets, and you need deeper pockets because, as we said, you may have an apartment in a duplex that's vacant for a month. You could have a commercial space that's vacant for a year. And so you've got to have staying power. And the bank wants to make sure that you've got that, you've got the reserves, you've got the capability, and you're going to have a commercial loan which is going to require a larger down payment, usually 35%, and a little bit higher interest rate you're going to be charged. So commercial is a wonderful thing to have in your portfolio as your portfolio grows. It's not something I'd want to see you start with. Once you've got 8, 10, 12 properties, for sure add a commercial in. It'll give you a great cash flow. It'll give you great return. It'll give you ease and enjoyment of ownership, but understand that you may be vulnerable and you need to have some carrying power there. Hope that makes sense. Do your homework, especially in commercial and industrial. Make sure you know what the vacancy rates are, what the prevailing rate of rent is, and go for it when you find the right property. I want to thank you very much for investing your time. I hope you find it helpful. I look forward to talking to you again next week.